Welcome back, everybody, to another Budget 2021 review and highlights with the phenomenal Adam Lawrence of Partners in Property. Now, Adam, you've been with us on this channel many times before, and I'll drop a link up there for those who've not seen you on this channel. And you're what I call a bit of a rocket scientist. I mean, you make my brains fizzle because you just come out with the most profound stuff. Last night, we were having a discussion on yesterday's budget, and we felt it appropriate to actually share with you, the audience, where we feel the opportunities are for property investors, where the money flows are going, how all of this is going to affect your efforts as a property investor, and where you can make money, what the strategies are, what the new normal is going to be post this budget, and what the habits of people are going to be now that it's changed, where the future is for retail, commercial, residential property, and what the winners and losers are. So stay tuned, and all of that is coming up today. If you're not already, smash that subscribe button, hit the bell icon, and don't forget to share this video with your friends. So, Adam, yesterday's budget, what a corker it was. I mean, I read it and I go, Rishi Sunak wants us to have inflation, to increase the tax take, and to do it by stealth. What's your thoughts? Controversial, I know, I've put it out there, but what are your thoughts?
No, absolutely, Andrew. I think that the unstated policy is exactly that, pursuing that line of inflation. We've maybe all forgotten what it feels like, because these days sort of 2.5% is regarded as high inflation. But all the signs have been there for some time. The Bank of England saying they're not going to increase the base rate for some time. Well, obviously that's the primary tool for controlling inflation. So you take that one out of the mixer, and then you think, well, just like we do as property investors, if you take out a 100 grand mortgage 20 years ago and the property was worth 150, when the property's worth 300 at the end of the term, you still only owe 100 grand against it. So your 50k equity is 200, and the government's not looking, I don't think, in too dissimilar a way at that at the moment. You know, they've run up a big bit of a bill in the last 12 months. I'm sure you've noticed few hundred bill of a bill. And there's a few hundred more to come.
Of those bills.
And there's another 355 they want this year, and they usually overshoot rather than under. So we'll be at $750 billion by then on the back of COVID. Not small change. And I'm also not completely convinced it's all over on June the 21st, as Boris has told us. But that's maybe another video for another day, Andrew.
I think that's another discussion, that is. So what we're effectively saying, to summarize that, Adam, is the government actually want inflation to erode the value of their debt down, so that the debt becomes worth less, to give confidence to the city that actually we've got a great plan. And also by freezing all of the allowances, the stamp duty thresholds, ignoring the stamp duty temporary holiday until June and September, the capital gains tax, the personal allowances, the VAT thresholds, inheritance tax, all of those being frozen. Inflation's good, because if you get a pay rise, they get more tax. If asset prices go up, and we were talking possibly 8-10%, possibly more growth in house prices is coming up for us, then those sort of things are going to mean more taxes collected by the Exchequer, so they can pay down the amounts, as well as it being worth less to them in real terms. So, I mean, do you think that's a sensible thought, or
it's a seductive argument, isn't it, Andrew? That's the way I'd look at it. And I think most people would agree it's kind of the only sensible way out of what we've got ourselves into. But of course, what you've also always got to remember is inflation isn't necessarily this sort of well-behaving phenomenon. It has this habit of, when it's let off the leash, it can really rip through things. And 3%, 3.5% at the moment might be viewed as quite healthy if we can get there. And of course, Rishi's, He's stimulated the economy to try and get us to that point. But at 3.5, if you've still got a base rate that needs to be on the floor in a couple of years' time, let's say, who's to say it isn't 4, 4.5, 5, and after 4, it really starts to have some negative effects as well as some positive ones. So, it's a dangerous game to dancing with the devil somewhat, isn't it? Really, and we haven't dealt with it for what properly for 30 years.
I was going to say 25 plus years, really, isn't it?
Rishi's a young chap. He can't remember what it was like, I'm sure. So. It's not. It was devastating in the early 90s, wasn't it? And certainly in the late 70s and times when we've had some nasty inflation situations. So we shouldn't forget that. And of course, we do live in a new base rate world these days and all the rest of it. But it's one of those things. I wouldn't like him to have to. I think they've been quite good, Andrew, at forward guidance and foreseeing what might happen. Yeah. And I just hope they don't get too complacent and not. They might have to sort of choke this one off slightly a little bit earlier than you or I might like some point down the line, I think.
I wouldn't disagree with you there. Now, you touched on an interesting point, low interest rate environment that we've enjoyed. Now, there has been a lot of speculation about it not just being a low interest rate, but going to negative interest rates. Now, personal view, I think it's highly probable. When you look at the data, January last year, £5 billion held in savings accounts. We look at December last year, £6 billion. During a lockdown window, because we could not go out and spend at leisure complexes, entertaining ourselves, holidays and the like, we saved £1 billion as a nation. Now, what Rishi wants to do is encourage us all to get out there and spend. And if we spend, that drives inflation, which is our first point that we've just made. But also it encourages us not to keep the money in the bank account because it starts going down in value, a bit like happened in China. Therefore, is that a good thing that we get out there and spend £1 billion fast? And Rishi's just chucked a load more in grants and furloughs and new bounce back loans and all this extra funding to kickstart the economy in April. Do you think that's good?
I think it needs kickstarting. I think we need that multiplier effect that we lost so quickly when the pandemic hit. The money's got to be in the system to circulate. The big difference between where the money's gone in the past 12 months and where it went, say, after the financial crisis, all that QE that just went into inflating assets, realistically, that 97% of the population don't really see any benefit from. This is a different, the money is in the hands of the people at this point, isn't it? But it does need to move because you've seen a huge increase in the money supply. And the danger is, of course, if that then does start to get real velocity, that will be quite significantly inflationary quite quickly. So caution is needed, of course, but we have to drive, if you look at the big threats, if we were having this conversation 10, 11 months ago, we'd have been saying, well, there could have been deflation, there could be hyperinflation, there could be stagflation, there could be all of these things. And really, inflation is the lesser of all of these evils. But I do have a fear, Andrew, and that my fear is inflation as a byproduct. I wrote an article the other week, and I called it Fakeflation. I'm concerned that's what they're going after. Inflation as a byproduct of a healthy economy, totally in favour of that. We all want a bit of that. Because there's a reason the Bank of England set target at 2%, a modest inflation that signifies a healthy economy. If we're pursuing it and starting with the goal of inflation and throwing a lot of money, time and effort at getting to that goal, my fear is we've taken our eye off productivity. We've taken our eye off what we really need in order to make the economy healthy in the longer run. Although I do feel that Rishi did a bit yesterday in terms of getting that to work as well. So, it's not a done deal, but I do have a fear that we're going after the wrong type of inflation.
Yeah, I think we have to be very careful about the inflation we get. Limited inflation in goods and services is healthy. Not rampant inflation, but a little bit above that in terms of asset appreciation is good, because the asset appreciation effectively hoovers up the surplus cash from the economy and locks it away. So in a good sense, you want that to happen for things to perpetuate forwards in a positive way. Now, what do you think is going to happen as time goes on? I mean, we've got all of this corporation tax noise where they've proposed and kicked the can down the road, which is sort of announced the bad news today, but you feel the pain tomorrow when you've sort of forgotten about it. And we were talking about the IR35, announced some time ago, happening on the 1st of April. How much of that was mentioned in yesterday? But well, it was forgotten because it was all about yesterday's budget and the future. So do you think it's a good idea to jack rates up to 25%, where it still makes us the cheapest tax take within the G7 and within Europe, generally speaking? So America's closest at 26%. But do you also think that causes the counter argument that actually the accountants in the room start to tinker about around the edges because it becomes cost economic to deploy strategies? And you know, we've got some graphs of that showing that effect. So I mean, do you think it's a sensible thing over time?
Well, look, I'm a big fan of the date. I'm an economist through and through, really, in these situations, Andrew. And I believe that the role of government, as far as tax is concerned, is to attempt to maximise the tax take, whether they be Labour or Conservative, and it should be sustainable. It should be done over time. So ultimately, pursuing policies that maximise the take would seem to be the most sensible. And as you correctly said, the data's fairly clear on this, in that raising tax from the rates we're at the moment is probably not going to increase the corporation tax take. I suppose at a really simple level, if you're going to pay 19%, that gives you an 18% budget to pay for clever accountants to save you 1%. If you're going to raise it to 25%, you've got a 24% budget. So you've increased your money to deploy at mitigation by 33% or something like that. So realistically, it's a surprising thing to hear out the mouth of a Conservative Chancellor. They've spent so much of the last decade banging on about getting the corporation tax rate correct. Of course, 18 months ago, we might have been talking about 10% tax was being floated by Boris as a post-Brexit solution. That's obviously long forgotten at the moment. And then we've got our free ports to consider and all the rest of it as well. So,
Well,
I'm not in favour of it.
Yeah, the free ports are an interesting concept. Call me old, grey hair and all that. I liken them to enterprise zones. Do you see them as being any different to enterprise zones? Just a new name?
Well, we need to. I mean,
then we launched ISA.
I don't know if you knew this before yesterday. I certainly didn't. But we had free ports up until 2012. I didn't realise that until I read a particular post-mortem yesterday evening. So yeah, I mean, politics is all about naming stuff and marketing and strap lines, and they're doing so much feeling out of the population at the moment. I guess it's not a surprise. I was pleased to see where they were located, and I think there was more done for levelling up, as they're calling it. That's the strap line, isn't it? For nearly 5 billion put into levelling up across the country. It's needed. It's good to see some of the money that's gone to the devolved nations on that front. But you're right. It's difficult to. I mean, obviously, we don't know the detail as yet. What will they look like? It just gives them an element of flexibility, doesn't it? And an element of, will it be no tax? Will it be low tax? I mean, you could call them a glorified bonded warehouse, depending on how they work realistically.
I actually gave a talk 1 month ago at a property meet, and that question came up, and I actually used that exact analogy a month ago. but basically it's a bonded warehouse on a larger scale.
Yeah, yeah. So it'll be interesting to see what the real effect of that is. But you'd hope for, some areas like Humber. I'm pleased to see that's been considered, because I think it needs some significant investment.
Now, that's a really interesting one here, because these free ports are designed to actually create innovation and make us a leading force in technology and innovation in these areas. Now, I gave a talk a year or more ago, and people were saying, oh, Brexit this, Brexit that, Brexit the other. And I sort of looked at it and I went, well, let's have a look at the bigger picture here. We're a tiny island with a very small economy in the global economy. And we're buffeted by the trade winds, a bit like a tornado passes through the Bahamas and West Indies and areas like that. Therefore, we are going to be buffeted by other nations. Now, as a country, we've immunized more than 30% of our population. We have the third highest level of immunizations of any country out there. So until all these other countries get going, aren't we just a bit of an island? And what we're doing is we're setting our stall out to trade ahead and outflank and outmaneuver other entities and countries, but also putting corporation tax up. Doesn't that make us less of a chance of being a Singapore, where we're a tax haven? All it needs is a European entity to tweak their rates below ours, and all of a sudden people offshore their businesses, as we've seen before in the past.
Yeah, I think that's a perfectly valid point. Ultimately, if someone comes up with a 10, that was the whole point behind the 10% logic, wasn't it, realistically? Yeah. So you can't suddenly turn that on its head and then use a completely different argument, because one of them has to be incorrect ultimately. So I completely agree. I think, we've definitely stolen a march in terms of, September last year, we looked like a very undesirable destination for students, for example, and ultimately for tourists, had there been any real tourist trade to be done. Whereas September this year, I suspect we might look much, much, much more attractive. But then, of course, on that front, we've also levied the 2% stamp duty increase on foreign buyers as well when we come back to Resi. So there isn't a lot to be encouraging, foreign investment on the individual level at the moment, I don't think. And in terms of, foreign direct investment, or in terms of, we've historically, a lot of our, we've got a huge requirement for renewables in the next 4 or 5 years, and beyond that, of course. And historically, we've been getting our money from abroad for that. So we do need to bear these things in mind. So unless we're going to see tax breaks on those sectors or within those zones, or however that's going to work, at least I suppose the Freeport does give you the flex to do that. And that might be a nice loophole that we see some bigger companies exploiting in order to get themselves into Britain. I did see an article the other day that said there's 1,000 European firms that now want a headquarters in London that didn't have one before Brexit. So it's difficult to measure some of these things. And we need to kind of see how they play out, because obviously there's also quite often a bit of a political agenda behind these sorts of stats, isn't there?
I couldn't agree with you more. And we as a nation have examples such as Arm Holdings, which was sprouted out of innovation centres in Cambridge.
That's right.
So that's a great example. And also, we'll get onto the residential and property in just a second, but the Hong Kong, you're talking about foreign investment, 300,000 Hong Kongers want to come to the UK to secure their residency here because of the changes that are happening. So that's a lot of foreign inward investment in the UK coming to actually relocate. So let's give the audience something property related. This is strategies now, property strategies. In your opinion, where is the market going? What strategies are going to work? Which ones are going to fail? Is rent to rent, which has struggled massively through lockdown, going to suddenly boom? Or is it a buy refurbish, commercial or residential, tin sheds or retail shops? What's your take on the market, Adam?
I'll try and answer all those in one sentence. No, I won't, because that would be impossible. But I think if we pick some bits out of that now, commercial or residential, interesting at this point, because I think Resi proved last year, vanilla Resi proved safe and boring, and the commercial equivalent of that, certainly years ago would have been retail probably.
Yeah.
And of course that took a particular hammering. Commercial, residential vanilla buy to let has held up very, very well. And I think it'll continue. It has a place in a portfolio because it will continue to produce those returns. It may not set the world on fire. Now, commercial, I don't think we can tar with one brush here, because we've got to just chop it up into the component parts. Because we had a chat before we came on, didn't we? And we were talking about big winners and big losers. And what we probably agree on is we're probably not going to see much flatlining commercial. It's either going to be a big loser or a big winner this year. So we need to look at your tin sheds that you mentioned, for example. I'm still very, very bullish on light industrial for years and years to come. The writing's on the wall. There's not enough of it. Everybody wants it. They're finding more uses for it, not fewer. Everything points to the bond market of property, which would have historically been retail, I think looks a bit more like you can still get your long leases. I mean, what's not to like, Andrew, realistically, about your tin sheds?
Absolutely. They're simple to maintain as well for the owner occupiers. And generally speaking, those noisy lathes and grinding machines and stuff fit in them. And if the guy next door is Amazon's courier, Amazon aren't going to moan that they've got some industrial noise next door, because it's what you expect, or a motor workshop. I think tin sheds is a fantastic opportunity. I mean, offices, we've all learned this: work from home, work on Zoom or Microsoft Teams. Other platforms exist with Cisco and others, but before I get slapped. But again, that has led to the office market shifting significantly. I know there's a major top 10 global bank with headquarters local to me. They had about 10,000 staff in their headquarters. They've closed it and they've made a statement, we're never reopening it. Now that's going to need some repurposing.
It really is, isn't it? And I think even when we go into office, we've probably got to go a little bit deeper and talk serviced, or we've got to talk suburban / versus city centre location. Because I see a big need here for serviced suburban. I see that being a fantastic market. Whereas if you're talking about those sorts of buildings that are, many, many tens of thousands of square feet, and it's a serious project to repurpose them, because they're probably not coming back as a global HQ style building. So you might, if you're lucky, be able to chop it up into component floors and maybe make some serviced in there and stuff. But you might be looking at a really significant Resi project, or you might be looking at an all things to all men kind of solution. And, maybe there's some retail above. I went to a hotel in London before that, in those days when you could go out, you might remember them, in 2019 with a really good friend of mine. And it was a rooftop hotel, effectively. And the rest of the building had some really good covenants, like LinkedIn and people like that were in the building. Really, really high-end, nice prime London location. And it just had the rooftop bar and the restaurants and the terrace and everything else. And that's sort of very, very clever usage of a city centre site that could rescue something like that. But of course, you've got to put in the time, the effort, the energy, the creativity, and the funding. And it's going to be quite a one to unpick for a commercial lender, realistically. It's not going to be an easy one to finance. So, are these big slabs of cash going to come in and redevelop these properties? Only if there's grant incentives, realistically, Andrew, I think maybe, something like that. So there could be, look, there's big change. So there's going to be a period of dip before there's a period of, I'm not saying urbanisation is over and cities aren't going to be an incredible thing in 2030 again. But if we're looking at what people can do in the now for the next few years, then I think there's going to be some big opportunities. And city centre could come off the top a bit before it gets better, for sure. For sure.
Well, I think the government recognised this last year, and I did a whole series of videos on knock down and rebuild, adding 2 floors,
Yes.
and all the other planning permitted development changes, and the new GDPO that's coming out, along with the new national planning policy. So all of those, there's so much up for grabs in terms of redevelopment of space. I think it's huge opportunities. So talking redevelopment of space, what's your take on retail? Going to fly? Everyone's going to stop using Amazon now?
Seems unlikely, doesn't it, realistically? I think, though, you mentioned it earlier on in terms of there's an experience element to retail that needs to be brought to life. Now, you've got your retail that will always need haircuts. I don't see being done by drones at any point in the next 10 or 15 years, realistically. So,
I think my drone did quite a good job.
Well coiffured, Andrew, that's for sure. That's for sure. But I think, there's certain things that can't be replaced. The aesthetic salon, whether it be female or male, that sort of experience, I see that being more and more important. So there's that side of retail which can't be done online, realistically. But I think if you can make people, you can make them get out of their seat to come somewhere for something and provide value-added services, then that's another angle on the revival of the high street, or this death of the high street stuff is nonsense, as you know. It's just the repurposing and the journey, and how long is that going to take? And what's it gonna need? You walk through your average town centre these days, and you see different things than you used to. You would have been looking at banks. What a great covenant! Betting shops. What a great covenant! These have fallen on hard times, realistically. Not the businesses per se, but the bricks and mortar side of the businesses. Yeah. But then you wouldn't have seen vape shops. You wouldn't have seen cat cafes. You wouldn't have seen. But there is an experience angle to those that doesn't exist within money is the ultimate commodity, realistically. And you can do that online. You want Starling or Tide or Monzo or whatever to do your couple of clicks on an app. No worries. I've even got a bot watching what my spending is to tell me I'm spending too much or whatever. It's dead easy. It's low effort. So why do I want to get into a queue in a rubbish old building that's got shutters and I don't want to do that. I don't want to. So that's a bad customer experience, and we need good customer experiences. Now, people are getting. If you look at a dessert shop, that would be another good one of something that's come out of nowhere in the last few years. Good experience, nice food. You're not going to spend a fortune in there, but great margin business. And those boys, some of the good ones, are turning over tens of thousands a week. So you've got real opportunity there for people, and we're going to see franchises and we're going to see startups this year. That's inevitable. The government's thrown a lot of money at making that happen. It always happens after an event like this. So there's loads of opportunity and empty space, realistically, as well, to do it in.
Well, I think you're spot on. I mean, I think once we get through and past the lockdown, we are in what I term the roaring 20s. Things are just going to boom, boom, boom. Now, we might have a bust in 2030, but that's 2030. We'll approach that as we get nearer there. But it's going to be party time for everybody. Everybody's fed up of being locked up. Now, I know that you've also recently done a reasonable commercial purchase, and that is in the leisure sector. That is perfect timing for people getting out. They've not been able to go to those experiential places. So you've positioned yourself at the bottom of the curve, ready for the rocket to take off. Very smart investment, Adam. I mean, we'll perhaps discuss this on another day.
I'd love to, Andrew.
Want to chip in at this point as to the psychology behind why you did it and the economics?
I think I'm happy to do that. I think what people watching might be wanting to hear as well is, where does that sort of deal come from? And the opportunities are there at the moment, and they'll still be there, because this has given people a reason to press the pause button, look at their life, look at what they're spending their time doing and all the rest of it. And then also on the commercial side, for the bigger sites, if you owned something that was low effort, that had decent long leases on it, and now it needs a lot of asset management, because this site we've bought, it needs a lot of asset management, especially at the moment. Now, we're putting a lot of time into it. I'd like to think we're up to the task. We'll find out, won't we, realistically? But it's that confluence of opportunity, and then throw the grant funding on top for restarting and rates breaks and everything else. And what you were saying earlier in terms of people, be the roaring 20s, they're desperate to get out and do something that at the weekend that isn't, let's go for a walk. I like a walk as much as the next person. There's only so many walks you can go for, Andrew, ultimately, isn't there? So people want to get back to leisure, comes back to that experience. They can't wait to do something, a bit of family fun, time with the kids outside of the house at the moment. There's not enough of it. Time with the kids inside the house, there's too much of it, realistically. So I think, that those opportunities there ours was a charity that owned the site, and they wanted to divest. It was good timing, and we felt it was good timing to get in, realistically. And that's the crux of where it came from, I suppose. And then funding. We had a brief chat earlier on about funding and the changing covenant. So we've got support of a lender that puts a lot of muscle behind us, because they've got a lot of faith in our team. Not everyone's got that. If you're sitting on a loan at the moment, there were two problems really at the end of last year, weren't there? There was, on the one side, worrying about covenants and lenders looking at that side of it. But on the other side, they weren't getting a lot of money out the door, were they? So new loans were a lot easier than existing loans. So there was an opportunity, and that will play out throughout this year. I'm absolutely sure about that.
Well, talking loans, there was, two things. We've obviously got the Green Bank, as it was termed, putting £12 billion into infrastructure and development projects which offer green returns. So we both know Evan McDonald, who develops large sites, and he makes them zero carbon. So we'll benefit from this sort of initiative. And what you also said was about the covenants. Now, this brings us on to creation of opportunities, because if you've had a bank, which you've used as an example, as your tenant, and all of a sudden that bank vacates the premises, you've gone from having a tier 1 covenant to tenant to perhaps having a vape shop where the guy rents his flat, he doesn't have a deposit, and your tier 1 covenant has gone down to nothing. And your bank all of a sudden might visit you and say, "Dear sir, we agreed a 65% loan to value facility. Your current valuation based on your current tenant now means put your hand in your pocket and find £200,000 to bring you back within covenant." And that's going to create opportunities of stock coming to market where owners don't necessarily
into the auction it goes. Yeah, absolutely.
Yeah.
Absolutely.
So we can see that coming up as opportunities. So let's have a look at the strategies then and list a few off. Serviced accommodation, Adam. Where do you think serviced accommodation is going? Upward or downward over the next few years?
Well, I think if they, the guys who've survived the pandemic, I think they're in a really strong position right now, especially if they're going to get a piece of this restart grant style stuff. Those who pivoted and worked super hard and got in the key workers or all sorts of alternative tenant types have probably, broke even, maybe made a bit of money last year, and now they're really those occupancy rates are gonna fly up. I mean, we're talking, the contractor market. There's all sorts of infrastructure projects that have been delayed, small ones that are now going to need to take off. There's going to be a huge amount of people in transient accommodation, Monday to Thursday sort of stuff going on. Staycationing is going to go through the roof. Jeremy Corbyn's a distant memory. So the second home, for lockdown reasons as well, has become more attractive again. We're not all worrying about second home tax or whatever. So that's buying and renting opportunities for people from the southeast or other parts of the country where there's money there. You know, there's big opportunity there, I think, as well. So I think service will do really well, Andrew, to be honest.
The service to holiday accommodation and holiday lets, we're predicting a positive upswing.
I think so. I'd be surprised if it didn't do well over the next few years. And of course, London, a lot of units have been taken out because they've gone onto ASTs to try and survive COVID. Now, there's an eviction ban in case nobody had noticed. So they're not going to be able to turn around and suddenly turn these back into SA straight away. So London Prime has probably got a really good sweet spot if you're lucky enough to be able to get some units for the next, and that maybe takes another 12 months to play out, maybe a bit more, because you said earlier, you know, you're quite right. It's not just about, we're handling the vaccination phase of the pandemic really well. Is France, is Germany, is Spain, is America? In Texas, they've just mandated they're going to take off all masks, all restrictions are off, pandemic over, off you go. I can't see that working that well, Andrew, if I'm honest with you. And we have a lot of American visitors, and there's more of this to play out in the States so far. So, you know, we need that. And of course, what we will need to do is to be able to attract the tourists back over from the Asian market who are very pandemic sensitive and are a lot 20 years ahead of us, quite frankly, in terms of their disease management and hygiene and all the rest of it. So, you know, if we are the standout destination in Europe, whether we be in the EU or not, then that's going to, you know, we might steal a march there, and there might be a real significant shortage of short-term let accommodation.
I would totally agree with you. Now, if short-term and holiday lets are going to do well, short-term, we talked about briefly plain vanilla doing reasonably well last year, but we've also just mentioned the eviction ban. Do you think plain vanilla is going to continue and be a solid stock?
Well, we can't carry on with 8.5% rises on an annual basis and everything that's going on. There has to be a bit of a flat line / correction at some point before that inflation kicks in that we were talking about earlier. I think when the horse then comes out again, there's going to be a reason for that to happen. But a lot of that was stock driven, Andrew, ultimately supply driven. You know, there's reasons to believe that might even itself out and maybe even the pendulum swing the other way. So I think it could have a volatile year, considering it's not very volatile. And I've compared it myself earlier to the bond market, but it could still be a volatile year for resi in general. You've really got to break down those numbers and see where all the transactions are happening. I mean, the big one in England, it was still all happening between 100 and 150k. So the market was still busy around that lower echelon, even though there was a fair bit more activity in the 500 grand plus market because of the holiday, you know?
Absolutely. Well, I sort of, in my budget report yesterday, put it out there that Boris and Rishi's strategy is to encourage first-time buyers and discourage renters, which first-time buyers will pay more than a property investor for a property, thus inflating the asset prices, which then incentivizes perhaps a landlord to sell, because if his tenant moves out and there's fewer tenants to move back in, he might as well sell to them with some form of assisted sale process, because people generally don't want to move if there's turbulence involved in moving.
No.
So do you think there's an opportunity there for landlords to release cash and redeploy it in strategies that will get a better return?
That's a really interesting point. I think, you know, when I looked at the figures at the weekend, the first time buyers in the first 10 months of 2020, which is the only figures we've got at the moment from the ONS, it was down 53% from 2019. 53%. So there's a lot of people who probably could have bought. Like you said, savings balances have gone up, but they haven't bought. But I think the thing that's not really being talked about at the moment is the developers like Persimmon obviously come to mind because they made so much money out of Help to Buy. Now, they've got a kind of reverse situation with this 5% mortgage scenario, because now you can get the leverage. You don't have to overpay for the new build that let's face it, if it's Persimmon, maybe is not the best quality if you followed some of the videos I've seen on the internet. And they can do that in the secondary market now, where they're going to get more bang for buck. You combine that with space, because you always get less space in a new build.
Yeah.
And then you combine that with the fact there were 110,000 fewer housing starts last year. I see some of the developers of certain stock having a tough time because their pricing's not going to hold up like it did last year, ultimately. And what does that mean for us as investors? Like you say, that drags the secondary market along. Never forget that, you know, the retail market is so much bigger than what you and I do. You know, it bosses the prices.
We only account for 20% of the market.
Exactly.
That said, the retail is around about 30% and social about 47%. So, you know, it's a big old market out there. Yeah,
and I think there will be opportunities that fall out the back of that, without a doubt. And I think there might even be opportunities in new build sites that haven't achieved what the developer thought they would on a smaller basis. And there could be deals to be done there as well, potentially, especially for people who like the idea of a build to rent style philosophy. Yeah, it's going to be interesting.
Okay, so we've done single lets. What about multi-lets, HMOs?
Yeah.
Do you think that is a boom market? I mean, we've just had Brexit. Are a lot of people leaving the UK? Are we attracting people into the UK who might want to live in a HMO? Where's the demographic going? Has lockdown driven people up the wall because they now demand ensuite facilities because they don't like sharing?
I think there's a good point in there, certainly right at the end, in terms of you'd have to split ensuite from non-ensuite. I think that the scarring of COVID is going to last some time, but ultimately HMO for a lot of people it's the option they can afford rather than the choice. You've only really seen top quality HMO for the last 5 or 6 years, haven't you? To be honest, it wasn't really a thing before that. So you've got that side of the market, but what you've seen in the last 12 months is, you know, what in economics we call a substitute good. So people have been able to move out of HMO and either, like you say, repatriate to their home country, or they've gone move back in with mum and dad. You can't do that in a vanilla buy-to-let 3-bed semi when you've got 2 kids and a dog. It's not an option ultimately. So the substitute good has kicked in, but I think HMO has probably taken its kicking on that front. I think ensuite quality will still demand a premium. I think the other end of the market will still get people who can't afford any more. So that'll be interesting. But I always wonder with HMO who gauges the actual size of the market. I mean, look, people have left the UK in 2020. We don't have real reliable numbers yet, I don't believe. But a lot of the papers have suggested from data they've seen hundreds of thousands of people left London and the UK. I think those people will come back relatively quickly, especially if it's worse in their home country than it is in England, for example. So I don't think there's a sudden reversal of the trend of people wanting to be in the UK. You know, the NHS, the stock of if the NHS was publicly traded, its stock price would be higher than Tesla's right now, wouldn't it? You couldn't have more goodwill towards the institution. And that's one of the things I know from knowing lots and lots of international students when I did my MBA, and lots and lots of people internationally anyway. It's one of the things that's most attractive about moving to the UK, and that's made it ever more attractive in the last 12 months. So I don't see that being a problem for medium-term supply. And as we've already alluded to, go back to our tin sheds. If you want to generalise about the workforce in the tin sheds, you know where most of those guys, and it is mostly guys, tend to come from, don't you? Yeah. You know, they're not coming from Nottingham. They're coming from realistically Eastern Europe and beyond. So I don't see that trend changing. And with more tin sheds and more requirement and more online and more penetration, we need more. We don't need fewer. So I don't know how that fits in with the Conservatives' ever-changing immigration policy, but that's another video probably as well.
Well, I know you did your MBA and you're going to be working towards your PhD in the future. You've already put it out there, so I'm holding you to it. So let's have a look at the students. I mean, we've got student housing, we've got purpose-built student blocks. where do you think that market's going? Do you think students, because I've got a couple of my children in university, and well, pretty much since lockdown, they've done everything online, Microsoft Teams. Do you think people are going to go back into the classroom? Do you think they will go back to the campuses? Or do you think that ship has sailed, or it's now a declining market?
Well, you've got a couple of live examples you can ask, Andrew, but I'm pretty sure they'll tell you, it's not just the academic side, is it? It's the experience. It's the whole point of going to university. Stand on your own 2 feet, experience things you wouldn't at home, find your own way in the world, form a part of all the university societies and clubs, and you don't get those opportunities by being at home on Microsoft Teams ultimately, do you? So I see, what do I think? I don't know the figures. I don't know if the figures are out there, but there've been an incredible number of students who didn't go into their first year in September. There've been a record number of deferrals. There'll be a record number of people who didn't come from abroad, right? That's pent up demand right there. That rubber band's going to snap back ultimately, and it's looking like it might snap back in September this year, which is good news for student landlords. In terms of ploughing into new student, purpose-built blocks and things like that, I'm always nervous about those. I don't think they stack. I think they stack up well for the developers. I don't think they stack up fantastically well for the end buyers. Leasehold is a whole another conversation, isn't it? But leasehold is changing, and I do see lots of ex-student guaranteed rent blocks that people are desperately trying to sell, and the reality is they've dropped 80% in value, and nobody wants to hear something's dropped 80% in value. So it's not
that guarantee. It was worth a lot, wasn't it?
Yeah.
But okay, so we've done students. What about the sort of flipping, property trading, buy, refurbish, refinance model? What's your take? Do you think that's got legs now because the market might move, or?
Yeah, I think if we're both right about the inflation thing, and it's very, very difficult to see another route there realistically. It's more a matter of how quickly it will happen, isn't it? Realistically, and what will be the pace of what will be the pace? It's not the speed; it's the acceleration that we're looking at realistically. And I think BRR makes a lot of sense in this sort of inflationary market. You'll do well. You'll make a bit on the refurb if you're like me and you tend to wait sort of 6-7 months before you have your revaluation, like most people have to, otherwise it won't really value up, then that 6 or 7 months might be quite kind to you. It might be a bit volatile and you might need to hold on a bit longer before you come out because of what I said earlier around pricing being a little bit all over the place. But once you've got it onto term, you're going to sit, say you put a 5-year fix on, let's say, in 5 years' time, I reckon you're going to be pretty happy with the numbers that are coming back. And then flipping, of course, like any development, it's always nice if the market is going to do some of the work for you. And if there's a feeling that the market will pick up there, then it's nice to see 5 or 10% of the legwork done by capital growth. I'm not sure, as I say, timing is everything, and I don't know when these events that might knock the market keep getting pushed back and pushed back and pushed back. So it's difficult to say with any certainty on that front, and I think you're going to want multiple exits, really, Andrew. And I think holding for a couple of years post development might be quite attractive if you can figure out the VAT concerns you might have. But obviously, that's doable with the right advice, as you well know.
Absolutely, all of these things can be mitigated against through different ways of structuring your paperwork.
Nicely put.
Yeah, there you go. So you mentioned there about property development, and you touched on it with the major house builders like Persimmon and Barratt's, Wimpey. Now, let's have a look down at the smaller property developers, the people who are buying smaller infill plots, the stuff that the big developers won't work on. Do you think that is a marketplace ready to boom again, or do you think it might take a couple of years before that turns? Where's your thoughts?
I think you've got some challenges, Andrew, because materials costs are up so much over the last 12 months. And you know what these things are like. Even if they were more expensive legitimately during a pandemic, they'll probably be quite sticky where they are. So, you know, labour costs are moving up because of lack of supply of skilled labour and some of that, you know, reverse migration that you talked about earlier on as well. Labour and materials up, land prices, landowners are not quick to discount their land, as you well know. They've enjoyed very, very good returns over the last 40 years of it. So it does, something's got to be squeezed somewhere, hasn't it, ultimately? So I think development-wise, you might be needing to look at more creative solutions, promoting land, JVing with landowners, stuff like that, rather than just deploying big sums of money in order to make stuff work. Because I think there's probably a concern on that side of things. So I think it might be quite tough to deliver some of that. But then, you know, there are still developers I know who are managing to develop out at, you know, £800, £900 a metre. I don't know how they do it. I can't do it myself, but they do manage to deliver it. And if you can keep that cost advantage, and you can keep that competitive advantage you gain from that, then of course there's still profits to be made. And going back to your Roaring Twenties analogy, it is a time when people will think about crystallising assets they've held for a long time. And land is so often held for a long time, there might be some decent opportunities out there for people.
Okay, so looking at this and helping the audience by summarising what we're looking at, what we're basically saying is retail, there's opportunities to reproposition those properties. Offices, again, we need to look at how we can repurpose them to become multifunctional sites, potentially. Industrial is going to be a real safe haven and a growth market with very solid yields. Development might, for the smaller developers, not have the margins that it used to have, but serviced accommodation, on the other hand, could be in for a boom 5-year window. And high-end HMOs will certainly fill without problem, but if your HMO isn't high-end, self-contained, you might struggle for the next couple of years. What would you add on to that in terms of where do you see any losers come in?
Well, I suppose, I mean, I think there are a couple of losers in there, aren't there, in terms of certain types of commercial space, in terms of certain types of HMO. Although HMO, I'd encourage people to look at the social housing side of the model as well. If they need to flip it over to an RP, a registered provider, or someone like that who's providing enhanced support, there might be an exit there without, you know, incurring too much financial loss apart from anything else. So it's mitigatable. Like anything, Andrew, the harder you work and the more you think, the more it's mitigatable, as you know. So absolutely. I think the losers will be the people who can't be creative, who can't see the wood for the trees, who look at the building and say, oh, that's always been X. Well, from what you've just said, so what? Not bothered about what it was, bothered about what it needs to be today and what it needs to be for the next 10 years. So let's, you know, it's more about the thinking than the, I guess, you know, REITs and large pension funds are vulnerable at the moment. But again, and that's because of their super tanker style nature. They won't pivot. They won't suddenly start to asset manage a site particularly hard because that's what they need to do. Because it's not what they do. It's not what they do. They distribute money. They have obligations to meet, and that creates opportunity for the likes of us and everybody listening to this video, really. So the losers for once could be the institutions. And I think they've lost some money already. And like you say, in terms of, even if you haven't got that lender covenant pressure that you were talking about earlier, you've still got write-downs on your balance sheet. You've still got,
absolutely,
without a shadow of a doubt. So those sorts of things that come up, and those buildings, as you know, can be really big and really interesting. It's not just tiddly little stuff. It's really decent, you know, 7 and even 8-figure stuff that comes up, and you can really have a go at something if you've got a plan, and those sorts of things where you might be able to fix the problem in the now, but you've also got a development plan for 5 to 10 years in the future. That's where people can really cash in on what's been happening.
Well, that's the smart money, and I would 100% agree with you. Those institutions, they tend to be run by people who have gone and studied a formal commercial property qualification, either at university or they've got a RICS or something, and it's all about yield, and they manage the buildings by yield, but they don't manage the asset. And it's people like you and I who are good at spotting opportunities and markets moving and repurposing these assets. And an organization, pick Aviva, for example, it's not going to have a team of people who can go, right, we'll repurpose this building and make that bit retail, that bit leisure, that bit offices, and that bit residential. They haven't got the foresight, the teams, the project management to do.
Absolutely right.
And
Absolutely
that's where
right.
the opportunities lie.
Yes.
So, Adam, any closing thoughts or comments for the audience out there? Because we've covered a lot, and all of what we've said, from my point of view, what I'm seeing is this is all about inflation, asset prices going up, and all of that basically meaning Rishi gets his money without anybody actually having to take any changes to what they're doing now.
I think the bottom 20 to 40% of society will feel the pinch if they, especially if they're not generous with benefits rises in an inflationary environment. So I think I'd say there's a cautionary note on that inflation that we've talked about. I do believe it's inevitable. Some people will be losers from it, definitely. But I feel there's one thing I would like to say, because I feel quite strongly about this.
Please.
We've got a time where, you know, money in the bank, and you talked earlier about the negative interest rate, and there's a more than 50% probability that's going to happen. You know, if you've got funds, or family members have got funds that are not deployed or are deployed in bonds and things like that, they could be in for a really, really rough ride. If you're not on this journey, if you're not in this market, then it's going to race away from you. And if you thought last year it was difficult to buy, in 3 years' time, the likelihood is it's going to be more difficult to buy, or you'll be paying 20% more. So I would say, you know, take some action. Don't over leverage. Be safe, but don't be too scared of putting the chips in the middle either, because this looks like a phenomenal decade for real estate investment, whether it be resi, commercial, or otherwise. Realistically, you know, you don't want to be missing out on this. This is a boom. This is the start of a boom here, Andrew. And I'm sure in 10 years' time, we'll do a video where we talk about how clever we were.
You know what? I think 10 years' time, we'll look back on this, and I'll look at you as you've sort of brought Richard out on Necker Island and have invited me for this interview. and we'll go, it was a cracking decade. We were spot on. The only cautionary advice I would sort of give to the audience out there is, it's okay us being optimistic and bullish about our own country and what the opportunities are, but we are an island, as I said, and if America tanks it or China tanks it, their economies, and they don't vaccinate and they don't keep things flowing, that hurricane that passes by our shores will blow a few tents over for us. So we need to be very careful and be cognizant not to be too bullish and complacent, and to keep a wider macroeconomic outlook on what's happening abroad. So that would be my closing and parting shot for today. And I think it's only fair and wise. It's the risk warning that you get with any investment, isn't it?
Of course, absolutely right. And there's more volatility around at the moment than there's been for a long, long time. You know, it's not a done deal. I think that we both agree the trajectory is like this, but it won't be a straight line, Andrew, will it? It won't be a straight line.
Well, some things are going to go down, some are going to go up. It's going to be a wibbly wobbly line, and it's a case of identifying, as we've tried to help everybody do, which ones are going to be the winners and which ones are going to be the losers, and helping you to nimbly move from one to another.
Fantastic.
Adam, It's been a brilliant pleasure once again. I always enjoy our discussions and debates on topics. It's amazing how we think very similar and we come at it from very different perspectives. I love it. And I'll
Really
have
enjoyed it, Andrew. I always enjoy chatting with you. Always enjoy debating with you, and it's good fun. Look forward to the next time.
well, thank you, and likewise, I do too. And at that, I think I'm going to have to work out: shall I study for a PhD, or shall I put it into time working on acquiring commercial assets to reproposition, which will be more rewarding for me?
I reckon I know the answer to that one, if I'm honest.
I think so too. Well, thank you once again, Adam Lawrence from Partners in Property, and many other businesses that you will meet Adam in. He's got more businesses, I think, than the Queen has got changes of outfits and hats. So, on that note, we'll wrap for today. Thank you, Adam, for joining us. It's been a real pleasure and a delight. If you've loved what Adam has shared with us today, give him a massive thumbs up, drop a comment and tell him you agree or disagree and why you agree and disagree. And Adam or I will respond to those questions and comments that you put out there. And also, furthermore, hit that subscribe button, hit that like button, because you heard it here. We'll be interviewing Adam on his commercial investment in the leisure sector and work out, debunking why he did it and why he bought it during the lockdown, and going through the smart things that you can learn from that process and employ for yourself. So all the best, everybody. Until next time, stay tuned. Goodbye from Andrew.
Goodbye from me. Thanks, Andrew.